We can call this the most closely watched Federal Reserve meeting of 2018. The central bank expected to hike interest rates again today. But how will that move if it happens? They do have cover right now for it not to happen. But if it does, how does it affect the economy? Let's bring in Doug Flynn, certified financial planner and the co-founder of Flynn Capital Management, as well as Craig Dismuke, Vining Sparks Chief Economist. Good morning, guys.
Good morning.
All right, Craig,
Good morning.
I want to start with you. Big picture here. If the Fed does hike, how does that affect the economy?
Well, the impact is longer term. Obviously, in the short term, it'll have an impact on financial valuations, stock prices. You know, it's already baked into the market at this point, and so I think if they hike, you're not going to see a lot of volatility. I think the big picture, the big question is going to be how do they wrap that in some dovish wrapper? Longer term, the impact is more of a concern because the impact of monetary policy decisions comes 12 to 24 months later. There are already some headwinds coming down the pike then, and so that's when we'll see the real impact.
And quickly, Craig, how many hikes do you foresee then in 2019?
Maybe one.
One. Okay. Doug, let's bring you in. What signals are flashing red for you right now? I'm gonna help you here. Cracks in the market that have been exposed. Auto stocks are down.
Yes.
Building stocks are down. The banks, the Russell 2000, the small companies that we thought were immune to these trade problems, they're in a bear market.
Yeah.
What is the biggest crack to you?
Well, you bring up the small companies, and that's a good point. You know, as interest rates increase, they have a tougher time going to the capital markets for financing, so they're more reliant on the banks, and that does put a short-term hindrance on them. But, you know, the volatility, even though it's picked up much more than 2017, the range is still below the normal range. Like the high this year was up about 10%. We're down about 5%, not including dividends. So that range of about 15% within is well below the normal move of about 23% that we see. So while this is still within the realm of normal, it just feels a lot worse because of all the doom and gloom that's been forecast and because of all the pending, you know, recession talk and all that. But to Craig's point, I think that, you know, one or two hikes next year is well within reason. They have to fend off inflation, which is the big key that they're trying to control.
Right. Well, we have lower oil prices, lower gas prices right now. Where is the inflation? Alan Greenspan was on CNN, and he was talking about potentially seeing stagflation, but also signaling the end of the bull market. Listen to this, Craig.
It would be very surprising to see it sort of stabilize here and then take off again. But it's happened in the past. However, at the end of that one, run for cover.
Run for cover. What do you make of that, Craig?
Well, I think to his point, if you see stocks take off from here, it probably reinflates a bubble that was created by such easy monetary policy, both domestically and globally. And so I think the risks increase if you continue to see stocks run higher. So I think that's, to his point, we'd be concerned if we see a big move higher.
Concerned if you concerned if you see a big move higher. Why? Can you just explain that a little bit more?
Well, because I think one of the risks in this economy is the fact that asset valuations have become so high. As the Fed did quantitative easing, they extolled the benefits of that. Now that they are quantitatively tightening, there's presumably there's a negative impact from that.
Got it. Well, so that begs two questions, Doug, for you. How much lower would prices go? And then also, are you more concerned about the tightening of the balance sheet than over expected interest rate increases?
I mean, and to me, valuations are you know, the S&P 500 valuation is around 15 on a PE, which is well below the 25 and 50-year norm. So I think, obviously, if you have a good run-up, you hit some all-time highs again next year, you do get a little more concerned with rising rates. But, you know, the last 11 times rates have risen, the market has also risen 10 of those times because it typically denotes actually strengthening, not necessarily weakening. So although we're concerned, if they do it at a measured pace, and I think that's the language we're looking for, is how quick are they going to do it. If they do it at a measured pace and try to just control inflation and keep it reasonable, I think you're going to be fine with the market. Although at the next all-time high, if this spooked you, that's the time to relook at your assets and say, maybe I need to take some money off the table. Right.
So essentially the Fed is driving Santa Claus right now. The Fed's in charge if we're going to get that Santa Claus rally. Doug, Craig, thank you guys so much.
Absolutely.
All right.
Thank you.
You know, these guys, Lauren, we're talking about inflation.